Welcome back. You're still with us on Markets Today. Let's go to the rest of the headlines that we are tracking for you. To the fourth headline now. Jay Prakash Associates gained over 10% after the company's board approved the divestment of their cement business. Nimish Shah is here with all those details. Nimish?
So it's not only JP Associates but JP Power as well. Even both the boards today have approved selling their non-core assets. So for JP Associates, the board has approved to sell the majority of the cement assets. Now, if you look at the annual report, they have a installed capacity of 10.5 million ton, according to the latest annual report for JP Associates. So that's the first information. The second is even the JP Power board has approved selling the grinding unit. Now, what I understand from sources, a large conglomerate is going to buy the entire assets of the JPA group in today's deal. So that's the word from the sources. Now, if you look at the proceeds of this cement assets will largely be used to pay the debt according to the press release as well. So if you look at the group debt for JP Associates, it's close to 28,000 crores, which includes both short-term as well as long-term debt, and majority of the money which they will receive from selling the cement assets will be used to pay the debt. Now, the most critical part for JP Associates is one, the shareholders won't benefit anything because most of the money from the asset sale will go to the lenders. But what is important is the SBI, which is a lead banker in JP Associates, they were almost pretty much close to tracking the company to NCLT. Now that the proceeds have come or will come, there is a very high likelihood that the lenders will not take JP Associates to NCLT. So that's a benefit as far as the JP Associates is concerned. For JP Power, it's a small grinding unit is what I understand, a small money that they will get by selling this particular asset. And again, that money will be used to pay the debt in JP Power Venture as well. So official announcement from both the group is they are looking to sell the large part of the cement assets as well as the non-core assets, and the proceeds will be largely been used to repay the debt.
Nimish, thank you so much for all those details. Well, TCS has kicked off the earnings season and came out with its second quarter numbers post-market hours. Reema Tendulkar is here with the highlights of those numbers. Reema?
Thanks so much for that. TCS Q2 surpassing expectations in both revenues, margins, constant currency revenue growth at 4%, EBIT margins at 24%, expanding by 90 basis points, again higher than street expectations. The company's won orders worth $8.1 billion in the quarter gone by, similar to what they had in the last quarter. So that's a positive because the street was worried that with the challenging macros that we're currently in, the deal wins could show an impact. That's not been the case this time. In fact, the two troubled verticals, Europe as well as UK, have shown close to about a 15% year-on-year revenue growth. The only worrying point has been the hiring numbers. Hiring for TCS is sub 10,000. This is a big drop-off compared to the hiring numbers that they had in the prior quarters. Why is that? That's point number one. And secondly, attrition has gone up even further, 21.5%, but the management is fairly confident that attrition has peaked out. In a nutshell, TCS has delivered and beaten street expectations on both revenues as well as margins. So at least for now, this should allay street concerns.
To the fifth headline today, global oil prices dipped on Monday after markets booked profits on expectations of tighter supplies following OPEC Plus cuts ahead of the European Union embargo on Russian oil as well. Manisha Gupta is here with the details. Manisha.
Well, the crude oil prices clearly seem to be consolidating after 15% of gains in the previous week, which, by the way, was the best weekly gain in 8 months. We've seen the crude oil prices come back all the way from $80 off a low to around $98 off a high. So that clearly has been nearly $18 off a jump up that we've seen in case of the crude oil prices. Markets are taking support from the OPEC and allies output cut of 2 million barrels per day. What the markets had factored in was 1 million barrel. It eventually would be that, but that really creates nearly 2.5 million barrels of a deficit in the international markets. That is where the crude prices are taking support from. Today hasn't been such a great day because you've seen the US dollar index gain up to 113. This is in reaction to the US non-farm payroll data that came in better than expectation, and that tells you we perhaps would be looking at aggressive rate hikes going forward. That is what is weighing onto the markets, but crude oil prices, even despite of that, have seen strength continuing for them. The markets also are looking at Russia, saying that if they do face price caps from US and other countries, they would stop selling crude oil and gas to those countries. So there could be some more supply concerns coming in from there. Apart from that, it is also about the US inflation data that the markets are waiting for. And this week, you have China inflation and China trade data as well coming in this week. So plenty of data, and yet another volatile week is what crude prices could be looking at.
Oh yes, absolutely. Manisha, thank you so much for joining us with those details. And with that, it's a wrap on this edition of Markets Today. Thank you for watching.